Welcome to Plain Talk by Trillium Wealth. I'm Steve Laska, managing partner here at Trillium Wealth, and I'm here as usual with my partner and our chief investment officer, Matt Gomoll. Matt, I'm in a different location today. I'm in our New York office, and I don't have my gear set up, so already don't look as good as you on camera. It's making it tougher on me, so hopefully the producer will put you on more today. Today we're going to talk, one of the things you said you wanted to talk about was IPOs and how they go into the index, and I'm going to throw out a little bait there for you. Back in the day, which wasn't that long ago, when the Dow was struggling to get to 20,000, if Apple had been put in the Dow earlier, it would have hit 20,000 like 3 or 4 years earlier. But what was happening back then is there was a certain amount of time. There were certain rules based around when they were putting things in indexes. Not that Dow's one index, but as we look at things like the S&P in particular, that a lot of investors are invested in, I'm hoping today that you can demystify indexes a little bit and talk about what it really is. Often people say, like, how do you beat the S&P? Well, it already plays by different rules, right? Like, things go in and out of there without tax consequences, and people don't realize, like, you're not buying 500 stocks that stay there. These things kind of, it's fluid on what's even in the index, except for what's at the very top. So there's some stuff out there today with some major size companies coming into indexes on IPOs that's getting a lot of press, and I think it's causing some concern. So talk to us a little bit today, demystify indexes, and talk to us about some of the big IPOs that are coming.
Yeah, no, it's a great place to start because I'm hearing there's a lot in the financial media world talking about these IPOs coming. SpaceX is going to launch at the end of this week, so the 12th, I believe, and then Anthropic is going to be coming next. And these are just massive companies that people have heard of that have stayed private extremely long. I think SpaceX is 24 years old, actually, and it's somewhere in the 1.5 to $2 trillion market cap. That's massive for a private company. So along with this idea of, well, these companies are finally coming public, the doomsday folks would say, like, oh, this is the top, they're launching and that's the problem. And other people are saying, oh, no, this is good. Like, this is a sign that they need more money and they're going to keep running in the public markets. Who knows which way is correct? But really the purpose is for us to sit here and talk about what does this actually mean? So going back to that first part about what are indexes, passive investing is very popularized by Vanguard, Jack Bogle. And it's the idea of not making active decisions, of saying, I just want to own the S&P 500. And that's great. And for long-term investors, it can be very effective. The problem is we're seeing that index investing is actually a little more active than people realize, right? You're just letting the S&P 500 committee or the NASDAQ 100 committee or the Dow committee decide what's in or out. And there is some concern with that. So the way we think it's supposed to work is that there's really no humans in the process. It's just a set of rules. It's about, like, are you profitable or not? Are you this size or not that size? How long have you been publicly listed? And those all decide if you're going to be included in an index and then therefore a passive index fund. What actually under the surface is companies are moving in and out. The S&P 500 does not look today like it did last year or the year before that or what it will look like next year. It's always changing because the companies perform differently. Certain ones fall out, certain ones become included. The S&P 500 also has a subjective lens on it. There's a committee who decides and says, we're going to include this or not include that. It has to do with the having enough liquidity, what it has to be a U.S. company. They look at the float. So I'll talk about this a bunch of times today. Float means what amount of shares are publicly available. For context, in the SpaceX IPO, even though it's a possibly $1.7 trillion company, there's only about $75 billion of shares that are going to be listed for sale at the IPO. that's only 4.2% float. So float compared to the size of the company, it's going to be really small. Most really big companies have near 100% float, right? If you think of NVIDIA or Google, like they're really high float. And so their weight in the index is going to be darn near their market cap. So there's all these kind of different things going on under the surface that somebody like the S&P or the NASDAQ or the Dow might consider. There's also a bunch of other indexes that people may have never heard of. FTSE Russell, MSCI ACWI, CRISPR. So there's like a bunch of these things that we focus on the S&P, Dow, and NASDAQ because that's what you will see on the news. And it's easier to be like, oh, I know what that one is for most normal investors. So this gets to, I kind of mentioned that float issue of, well, when we're hearing this news of it's, a 1.7 to $2 trillion company hitting the market, how on earth is the market going to absorb that much of a company? And the answer is, well, there's only 4% shares available. So the amount that needs to be absorbed is 75 billion, not 1.7 to 2 trillion. So that's kind of where things stand on. Yes, the indexes are going to participate eventually, and I'll get to the rules on that in a second. But no, it's not $2 trillion worth of buying. And so it's a little bit of context for understanding where this thing stands.
Yeah. I think a lot of folks are going to want to know, like, so you mentioned some indexes there, right? And just to put in perspective, some that people might have heard on the periphery, like the Russell indexes, they take in so many more securities, right? It is much more rules based, and it's a lot of times the things that we follow. I think the question out there is, so how does that affect that index when it goes in there? So, and particularly with an IPO, that if people ever watch the IPO market, there tends to be this like sharp rise and this kind of drop back down to normalcy. Are you seeing anything out there when we talk about some of these ones coming in on perhaps that effect happening? So again, like SpaceX, I guess what kind of gives me some concern, not long term for our clients, Matt, is that historically tech companies had certain values where it was hard to really value them. It was always on the come, so to speak. Like they'd have negative EBITDA, right? Severely negative EBITDA and still be valued at whatever. So if you look at the stocks out there historically that were some darlings for a while, something like a Yahoo, which was going to be one of the biggest companies in the world, and now there's big companies out there that can buy it with the change in their couch cushions. So some of these companies like SpaceX, and I think it's a good example. I didn't realize it was that old, by the way. And I think, Matt, one thing is, like, I've read a lot of things, don't quote me in the exact numbers, but like 10 years ago, the average age of a company in the S&P was like 45. They were 45 years old on average. Now it's like 7. So this isn't a new phenomenon where we're putting young companies in the S&P, but the idea that a SpaceX, even if you're talking about the float, the idea that the overall valuation of that firm is $1.8 trillion, there's not really a lot of math that would support that. There's a lot of conjecture that would support it, but there's not really a lot of math that would say, yep, this company is worth more than Apple today.
Yeah, I mean, so that gets to the whole other issue of, is this valuation justified? What will it do? How much left is there to squeeze out at this valuation? Like when you're being valued at $2 trillion, we've seen it with NVIDIA. Like, sure, NVIDIA went from 2 trillion to 4 trillion real quickly. Is that likely with this one? No, I don't think so. So the other aspect there on valuation is, normally during an IPO process, there's a roadshow, which is the company enlists investment bankers to go to their clients, to go to institutional buyers and try to generate demand. So they're going out there and they're telling their story, and they got a pitch deck, and they say, here's what we are, here's what we're doing, here's where we think we're going. And we think our value should be in this range. And then there's a consensus of, well, what should we actually list these shares at? Right? You might have a company out there. In this case, this SpaceX is going to go public for $135 a share. Well, you could imagine in a normal roadshow process, that number could have been 100 or it could have been 150, but there's kind of a price discovery that goes on during that process of seeing how much interest there is and what somebody be willing to pay for it. Well, in this case, Elon, being Elon, said our price is 135. He just said it, and just said this is what we're listing at. And basically you go to, I don't know if he picked 20 investment banks to go fill the demand and say, all right, it's going to be 135. Here's the number of shares. I want you to go place them all. Now, interestingly here, he has earmarked 30% of that 75 billion for retail investors. Now, I could see this two ways, right? Either A, this is good that retail investors get included and have the ability to participate in an IPO when normally they might get 5% slice of an IPO. So all of the potential pop, if there were one, accrues to institutional investors. In this case, he's saying, no, I want to democratize it, right? That's the positive spin of giving a bunch of retail investors access to it. The other is we've seen what retail investors can do with GameStop, for example, with other these meme stock. They can drive the price through their purchasing in a way that is maybe not always rational. So maybe there's an aspect of he wants that participation. Negatively, you could say, he wants, like, there's a lot of hype around Elon. A lot of people like Elon and have followed Tesla for years. And so he wants to unload and know that they're going to, 30%, these people are going to show up, they're going to buy. So he's got that part taken care of. And then he only has to worry about the other 70% of the float that he's trying to offload. So, we'll see if this turns out to be a good or a bad thing with the retail participation. I think it was, whatever it was calculated. I don't think it was, some people are saying it's a sign of desperation, like he needed to do this. I don't think so. I think it was more him trying to say, no, I'm including retail investors in this process. The other aspect here of who else is going to, this gets into two things. So there's like, who else is going to buy if retail can only buy 30% of it? Well, who's going to buy the other 70% of it? That gets into this question of, well, we started by talking about indexes. Are indexes going to buy it day one? Well, no, they can't. There have been, and this is part of back to that conversation of, we think indexes are supposed to be rule bound, but what happens if indexes change the rules? Well, good news, the S&P 500 didn't change their rules. They met as a committee and they said, no, we're not changing our rules for early inclusion. It has to still meet profitability markers and time in market as a publicly traded stock before it will be included. That's great. I'm really happy that there was this kind of creates choice, right? There's you could be invested in the S&P 500 and have no SpaceX, or you could be invested in the NASDAQ or the Russell and get early access to SpaceX in the index. The FTSE Russell was the fastest change. They changed it down to 5 trading days. So 5 days after listing, Russell indexes will start being able to include this. The NASDAQ changed theirs. I think they were originally like, I can't remember if it was 3 months, but now they're down to 15 trading days. So about 2 weeks, well, three weeks after this Friday, the NASDAQ will be looking to include it in the index. The NASDAQ also, they have rules around how big you're represented in the NASDAQ index. And they changed it to say, well, if you're under 33% float, which we already discussed, it's at 4% float, you can only be this much. Well, they just put a 3 times multiplier on this. which goes back to what I said originally. In the NASDAQ, when it's represented, even though it's only $75 billion of float, they're going to treat it as if it's $225 billion of float. Still a long way from, 1.8 or 2 trillion, but bigger than it ought to be. So that's like part of the concern. These index providers changing their own rules to get early inclusion. And what does that mean for index investors? That's kind of where that's going to show up. Now back to who's going to buy this thing. Well, because institutions know that buyers are coming in the form of the Russell and the NASDAQ at certain date, they'll do what's called warehousing the shares. So they will buy, when we're talking about that other 70% of the shares that aren't going to the retail investors, those shares will be bought by some companies and funds that just want to own it, and also bought by some companies who are saying, all right, I know I'm going to unload some of this to Russell in 5 days. I know I'm going to unload some of this to the NASDAQ in 15 trading days. And so they will do what's called warehousing, where you just buy the stock at the IPO price and you just sit on it with, you're not a long-term investor. You're just saying, I'm going to hold it for these 3 weeks until the NASDAQ comes in, and I'm going to sell my shares to them. And they're going to be forced buyers at whatever price it's at in 3 weeks.
So a couple things that I want to put out there for our investors or anybody watching that's not a client of ours right now. I would caution people to be careful of judging performance over the next year or so versus an index, because this could skew things one way or another, right? As on what their real investment is. But on the S&P itself, to get clarification, Matt, the S&P, and I think that's the one that people invest in most, right? That's the one they watch. That's
totally
the one that they're investing in the most, right? So normally the S&P is cap weighted. But what I'm hearing from you is that the S&P is not going to treat it like it's a $2 trillion company, but rather a $75 billion company, because they're going to judge it on the float. Now, if that's the case, that's not that big a deal. Like, I would tell everybody, all right, relax. They're basically putting a $75 billion company in here, not a $2 trillion company. If they were putting it in a $2 trillion, I got to tell you, I'd be very, very concerned. But here's the other part. So let's take the positive part, because again, perception is reality. I think people look at a company like SpaceX and they go, well, they're launching rockets. And that would be like saying, General Electric was just making refrigerators. Like, SpaceX has a lot of things to it, right? Like, talk a little bit about like doesn't SpaceX have like their own AI, and there's all kinds of things in that company. SpaceX is more of a name of a company than we just send rockets into space.
Yeah. So SpaceX is absolutely an interesting company. It started, there's a few different branches or divisions, if you want to call them that. One is the launch, right? They didn't invent rockets, but they have just perfected rockets to be cheaper than ever before and reusable. Massive difference, right? So what they're doing is they're bringing down the cost of launch, right? It used to cost a lot to launch a pound of material into space. Now it costs less. So launch capability is one. Then they've got the communications network, Starlink. So Starlink has a ton of growth potential. If you just think of like, well, what's the market cap, or even what's the revenue of companies like Verizon and T-Mobile and AT&T? And then think of everybody else worldwide. There's a lot of mobile providers, internet providers worldwide. And that is kind of the addressable market for Starlink, because it's a fabulous service. They're going to get to a point where, I think the new iPhones already you can do emergency texting via Starlink. It's going to get to the point where if they want, you could just have a Starlink phone, right? Like, you can have that as your service. We already have, one of our team members has Starlink as their primary internet.
I was just going to say that. Yeah, like she used the Starlink.
So yeah. And so planes are using it. So like all air travel is going to kind of move in that direction. Ships out at sea are using that for communication. So that is awesome. And that's a aspect of the business that's absolutely connecting the world and gonna grow. No doubt about it. Then you get into the AI compute division. So this is where there's a little more uncertainty of like, okay, how much of this is hype? How much of this is real? There is absolutely real earnings there. They have, like everything Elon does, he is able to push projects faster than anybody. He's whatever you say about him, he's skilled at getting things done, getting things built faster than other people. So he's building data centers faster than other people. He happened to have built data centers ahead of the AI boom over the last few years. So he has a ton of compute available and ready to go. And they just leased a bunch of it to Anthropic for like $14 or $15 billion contract. It's massive, right? So whether he wants to use that for his Grok AI company and their compute needs, or just leases it, either way, that's a big asset he has, and he's able to build more of that stuff. Then you get into the aspect of, well, he bought Twitter, changed the name to X, combined it with his AI company, called that XAI, and rolled the whole thing in. That's an aspect where it's like, well, Twitter's certainly not like a good business, and nobody's sitting here valuing SpaceX being like, oh, I get the revenue of Twitter. No, nobody cares. XAI is in the mix of frontier AI labs, but it's not an Anthropic, it's not OpenAI, it's not Google's Gemini. So it's kind of a mid-tier one. So we don't know where that goes. I would say there is talk of Tesla getting rolled into this eventually. So some of the things on the horizon I've heard of, Tesla getting merged in or getting bought by SpaceX eventually. And that would, really, we think of Tesla as a car company, as a car retail company. Is it GM and Ford, and why is it value? It's not a car company. It's a robotics company. And, when it comes to self-driving, when it comes to the innovation around robotics and solar and battery technology that they're doing, that's what it is. It's so they could stop making cars and pivot to robotics and pivot to batteries, and they'd be super valuable. So like there's all this stuff. They're talking about buying possibly Cursor AI, which is another AI company out there, and folding that in. So like there's stuff going on that's not the space side of it, right? That's the more AI, robotics, batteries, electrification side. And it's all going to be housed in one place potentially. So that's kind of like the interesting, where does this go? Do you bet against Elon? With the price target it's coming out at, sure, like anything can happen in the first year. It can pop, it can drop. It's impossible to say where it's going to go. Long term, there's a lot of interesting innovation that is going to be housed there.
I think that, it's funny how fast generations move, because, I look at myself and I can see other generations behind me and stuff, and it doesn't feel that way when you're younger, right? So Elon I wouldn't bet against him, because the guy he reminds me the most of is Steve Jobs. And Steve Jobs changed how we make phone calls, how we listen to music, how we do computers. And there's a lot of stuff that Jobs did where he could envision stuff that other people couldn't envision. Like the tablet technology was around forever. Somebody else invented it. He grabbed it and said, the only thing missing from this is the battery. I'll hold on until they get better battery power. Mm-hmm. They made fun of him, by the way, before he died, for saying that Apple was going to make TVs. They're like, that's the dumbest thing ever. And then he came out with Apple TV. Yeah. And maybe if he was there, they would have done full-blown TVs. But basically, Steve Jobs is the guy who's like, I'm going to put streaming services on TV. It's going to be a little box behind your thing. So he had this great vision. And I will say that's the difference between Musk and the other super rich guys to me. Like, I'm not saying they don't have vision, but the Bezoses and the Zuckerbergs and those guys and the NVIDIA guys, like, they see something in one thing and they've been great at seeing it and going down that route. But they saw a need and they filled a need. I think Elon Musk, like Steve Jobs, sees stuff where he's like, you don't know you need this yet, but you will, right? Mm-hmm. Some of the stuff, I don't think who the hell would want to live on Mars, for example, but he's on that. But I don't think the guy's motivated by money. I think he's motivated by doing just massive, massive things. So I am excited about it, but I also, this discussion is really great because I want to make sure our clients know that first of all, they will hear stuff in the press, by the way, because people will immediately go, $2 trillion company, it's going to dominate the S&P. Well, we demystified that a little bit. Okay, it's not going to dominate the S&P. They're going to treat it like a much smaller company. Even the Nasdaq treating it like a $220 billion company is not overwhelming the index.
Yep.
So I think it'll be very, very interesting on where things go from here. What I do think that I hope everybody keeps their eye on is that this is a precursor to more of this to come.
Mm-hmm.
Like more of this to come. I think you'll see companies earlier we're going to go into the index, right? And so however this goes will be something that I think is going to affect us as fast as companies are moving for the next 10 years or so on what we see happen in indexes. And it's interesting what you said about what indexes really are, right? They are at some level actively managed. Like I had the pleasure of meeting Jack Bogle a couple times and had to laugh at the idea that they were the largest passive manager in the world and they were a top 5 active manager in the world at the same time, right? So everybody would read his stuff and go, he says you should index everything. I'm like, he doesn't say that, right? They build ETFs, and he said ETFs should only be in the hands of financial professionals, but I can't control that, right? So there's some things out there where it's important for our clients to know that this is why we keep an eye on things. This is why we have clients in different index funds. And you and I look at stuff and certain things and say that index is very efficient. It's efficient from a tax standpoint. It's efficient from an investment standpoint. But that doesn't, rule everything that's out there for investments. So what else do you have for us, Matt?
Well, 2 things you mentioned there kind of spurred an idea. One is we will see more early inclusion. Like it's one of those things. Once you change the rules, it's going to happen again, right? Like, so they changed the rules for SpaceX. When Anthropic comes public, I don't know what valuation, 1 to 1.5 billion. That's also going to get early inclusion in the Nasdaq and the Russell.
You mean trillion, right? Not billion. If Anthropic's
billion,
trillion. I'll go get
one
I'll go personally try to get a loan for that.
Yes, yes. So Anthropic's next, and OpenAI's after that. I think there's a little bit of gamesmanship here of SpaceX benefiting from being the first AI-related company out the door. Anthropic's hot on its heels. They want to get in and have their IPO before there's a lot of right. The public markets scrutinize you and your earnings, and bad quarters can have a bad impact on your stock market, on your stock price. And so there is this aspect of let's get in there, let's get our IPO while everybody's still hyped. I would worry about OpenAI because they're going to come later, and the market will already have digested SpaceX and Anthropic by the time OpenAI comes public. Might not be great for them, and especially because they're kind of falling behind on a lot of metrics to what Anthropic is. So early inclusion, this wave of AI companies coming over the next year or two. The other thing that is kind of coming to mind is there were reasons companies stayed private longer. After the Enron and WorldCom scandals of bad accounting and bad reporting and all this stuff, there was the law, the Sarbanes-Oxley bill passed that increased the reporting requirements. Basically said, like, you need to have better reporting if you're a publicly listed company and have more internal controls over your finances. Well, that increases the cost and the burden to being a public company. We then, after the financial crisis, entered a world of tech innovation exploding, venture capital money exploding, and the combination of those 2 things was, well, let's just stay private and maintain control and not have to answer to public markets. And this is the end result of that. We are seeing that companies have stayed private much longer. There are now trillion-dollar companies. When a $1 billion company was a unicorn back in the day, now we have trillion-dollar companies. It's insane how big they are. And it made sense. If you're a founder and there's VC venture capitalists willing to give you money, why would you bother go to the public markets and have to deal with those headaches? So you just stay private and you do another fundraising round, and eventually it gets to the point where people want liquidity, and then you go public and have liquidity for investors. What we're getting into with AI is, it turns out, unlike software where you just write some code and then you replicate it endlessly, and it's a very low asset business, it's capital intensive to do AI. You need compute, you need power, you need all this stuff. And at some point, it is exhausting the amount of money that you can get in the private markets. So we're going to start seeing this shift where companies are going to be more capital intensive in the AI era. They need public investors to participate, because the numbers are, Google just raised like $80 billion by selling stock. Instead of doing a debt deal, they just sold stock, raised $80 billion pretty easily. But again, that gets to the size of what they need for capital intensive businesses. SpaceX is going to raise $75 billion, and they're going to use it for what they're developing.
I think that's the greatest irony in this one, though, because like Musk regretted taking Tesla public and fought to maybe take it private again. He basically bought Twitter and took it private, and now here a couple years later, he's like, "I'm going to go public with not allowed to do this yet." So, like I said, so there's sometimes there are some extraordinary people out there. While you have to take everything with a grain of salt. You look and go, I don't know. The guy seems to know what he's doing every time he does something at some level. Again, not the Mars thing, but some other stuff. So, all right, Matt. Well, that was a great discussion. Look forward to our next one in a couple of weeks. Hopefully, I'll have all of my gear set up here in New York as well. I left the stuff back in Florida and ordered stuff here and didn't get it set up in time. So hopefully we'll have that all up and going. And until next time, look below. We'd love you to subscribe, pass this information on to others. As I said, we get great feedback when people watch what we're doing. We're always open to suggestions on things that any of you want to hear as well. So thanks, Matt.
All right, take care.